this Fed might be on hold, it might be almost done. Do you think this data this morning backs that up?
I think it does. I think this is an in-line payrolls report, in line with market consensus, but also in line with Fed wishes. I mean, if you zoom out, if you look at the labor market data, we continue to trend down in terms of job creation, and yet we continue to see the unemployment rate that is still holding on around 3.5%. So that's really the best case scenario for the Fed, is gradual rebalancing of the labor market. By the way, job openings continue to come down as well. Labor participation rate continues to go up and is above pre-pandemic levels for prime age workers. So I think that's all that the Fed really wants to see. And of course, yes, there's a 4.4% wage growth number, but look, 4.2, 4.4, I think they're close enough. So I think the Fed is going to take that in addition to the inflation data that is showing a disinflationary trend, and we'll say this is in line with what we want to see, and therefore we may have to pause here.
You've had a great year on the equity market, much more constructive than most coming into the year, and you remained constructive. Now you're looking for that broadening out. Are there reasons to believe that can continue after it started around June this year?
Yes, for sure. I think the biggest reason is economic growth. I mean, if you look at, for example, the Atlanta Fed GDP now number they came out, the nowcast for the third quarter is running at 3.9% GDP growth. I mean, that is better than the first two quarters. It is an acceleration versus the deceleration that the consensus was expecting. So, you know, to the extent that that holds, that certainly bodes well for companies. It bodes well for the earnings upgrade cycle, and it should bode well for the stocks. So, you know, we've obviously seen, and speaking of, you know, what kind of stocks benefit the most, I mean, if you look at the performance this week, financials, for example, didn't sell off nearly as much as technology and some of the other sectors. And part of that reason is we've seen this, you know, re-steepening of the yield curve, which of course is positive for financials, but so is a soft landing. And so is, you know, the lack of major defaults. And so is, you know, the potential for yields to maybe go down from these levels. So I would say, Jonathan, for sure, there's a broadening out that is justified. And I like that it's actually being led partially by financials.